Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. It's a good day today. You had the equity markets here in India, or specifically the Nifty 50, that hit all-time highs. And this is after a period of as many as 14 months. Now, a lot of people are saying that it doesn't show up in their portfolio, and they're right, because a lot of people, retail investors, have their investments in the mid-cap space as well as the small-cap space, which hasn't risen as much in the recent past. But today, I'd like to talk about diversification. I'd like to talk about international investing, what the options are, and with a focus on the funds that are outbound from Gift City, and whether you should really consider going that route, especially at this moment where it seems that the Indian equity markets are finally breaking out of a period of consolidation, or a period when they went nowhere. I'm joined today by Kirtan Shah, Founder and Chief Executive Officer of Truvanta Wealth. Thanks so much, Kirtan, for taking the time. Let me first ask you about this. What is your opinion on international investment at this moment, at the end of November, heading into December, when there are conversations about an AI bubble and otherwise?
Alex, first of all, thank you so much for having me on the show. I think I'm on the side which believes that India's got a lot of meat to eat when it comes to investing in the domestic market. Like you rightly pointed out, I think we've gone through a decent consolidation over the last 12, 18 months versus the global peers. I think MSCI Emerging has delivered 3 times more return than India, and NASDAQ has done twice that of India, along with time consolidation. So I think at this point in time, once you look at the last quarter numbers also, our results that pan out were pretty decent at the BSE 500 level. And I think after such a long time correction and consolidation, finally, we see a lot of points that hint towards a better stock market return perceived based on India versus the global markets. I think because my largely thesis to invest is more downside safety, and currently at this point in time, we don't see a lot of room for error investing in the global markets. So I think I would stick to India, and I would stick to my allocation with 80-90% still on the equity side in India and 5-10% diversified globally.
Interesting. Okay. When it comes to investing globally, things have not changed on the regulatory front, right? You have a restriction from the Reserve Bank of India, which flows through to the Security and Exchange Board of India, which flows through to the mutual fund space. As a result of which, the mutual fund industry as a whole cannot increase materially its investment into some of these foreign markets. Parag Parikh, for example, has changed the way that it diversifies its own portfolio. You have a lot of ETFs that are also restricted on issuing new units. But you've had a lot of schemes open up in the Gift City, which is an alternative route, right, Kirtan? So can you explain that? And what are the offerings that you've seen that are currently available?
Like you rightly pointed out, Alex, there are 4 ways ideally you can invest in the global markets. First is you invest in an Indian mutual fund that is investing in the global market. Second is you invest in an ETF in India and get exposure to the global market. Third is you can also move on to platforms like the Money or the Vested and buy global stocks from their platform. And fourth is the Gift City route. Nowadays, in the first 3 is there is some or the other challenge. Limits are frozen in the Indian mutual funds to invest globally. ETFs are trading at a steep premium because they're not able to issue new units and there is demand. And when you look at brokers like the Money or the Vested, you probably don't know which one stock to buy. And hence, Gift City route is turning out to be great for investors who want to invest globally. Now, in Gift City, you have 2 routes. One is inbound and another is outbound. Inbound is when NRIs want to invest in India funds, and outbound is when Indian wants to invest globally. So for our chat, outbound is more relevant as a discussion. Now, there are a lot of fund houses like the DSP or the Mirai or the PPFAS or Access, which have outbound funds, which means that as an Indian, you can invest in rupee with them, but it particularly is a dollar denominated fund. And when you invest in those funds will then end up investing in global investments where you've invested. Let's say you spoke about PPFAS. Now PPFAS has a FOF fund on S&P 500 and NASDAQ. So when you invest in either of those funds, you are invariably investing in the ETF of a NASDAQ or an S&P, right? So what this does is it maneuvers around the limit that currently is holding back mutual funds or ETFs, and because of which you're not able to invest. So this is a great route for people who want exposure to global markets, can use these funds, which are outbound GIFT City funds, to take exposure to global markets.
What are the restrictions though? Because I looked at that DSP fund that was offered, and this was an actively managed fund, right? It would have certain restrictions on the size of the company that it would invest in, and it doesn't necessarily have to pick from the US. It can pick from various countries around the world, including Korea and certain other places, right? What are the restrictions though? Is there a minimum amount that you have to invest? Is there a lock-in period?
So when you look at outbound funds, Alex, you have to understand that there can be an active element and a passive element, like we have in the India mutual funds, right? Now, the DSP one that you're talking about is an active fund. The PPFAS fund that we just spoke about is a passive fund. So what PPFAS is doing is giving you access to ETFs directly of S&P 500 and NASDAQ. There is no active selection of where they are investing. Versus this, what DSP is doing is more active in nature, where it is open to pick stocks that they like across a couple of countries, and hence they are very different from each other. But what is very similar amongst them is that both these are retail funds. What I mean when I say retail funds is that they are taking a minimum ticket of $5,000, and you can then top it up with a $500 of incremental investment. Versus this, if you look at, let's say, one of the Mirai funds that are currently offered. Now, Mirai is actually a Cat 3 AIF from a GIFT City standpoint, and hence the minimum ticket size is 150K, $150,000 and upwards. So DSP and PPFAS are more retail focused, specifically on the PPFAS front, because we spoke about it, there is no exit load, and in general, you can come out of the fund at any point in time. And at the same time, like I said, the Mirai one is more Cat 3 kind of structure, where $1.5 lakh is the minimum. So you will have to keep in mind whether you want to look at the active strategy or the passive strategy. Because let's say if you look at the passive strategy of PPFAS, what they've done is they are investing in accumulating ETFs. What that does is when a dividend is paid out, that dividend is automatically reinvested, which is why there is no tax incidence on the investor. Because otherwise, in probably, let's say, an active fund, you buy a stock and that pays out dividend, you are actually taxed at 42% marginal rate. But of course, I'm assuming that active fund managers are going to be smart enough to understand how to tackle this, or probably not sell a stock before 2 years, because again, they'll be charged as a marginal tax rate. Now, this is the broader difference between active and passive, but I'm sure active fund managers are smart enough to maneuver around this.
Yeah, and that's fair. And I'm glad that you pointed those two things out. This is through the LRS route, right, Kirtan, effectively. And so you mentioned 2 years. That 2 years is significant because we're talking about equity products, we're talking about LRS route, and the taxation comes into play. You want to explain that?
Well, of course, like I said, the maximum limit is $250,000 because this is through the LRS route. Also, what we have to understand is when you invest more than 10 lakhs, there is a 20% TCS that is applicable. That's another thing. And from a tax point, all of these funds are typically taxed at the fund level. What that means is that when you invest, you will get a long-term tax NAV. And when you exit before 2 years, the exit will happen at the short-term tax NAV. But if you exit after 2 years, it will happen at the long-term NAV. What that means is that every transaction that is done at the fund house level, the fund house ends up paying the tax and not you, right? So what you receive in hand is completely tax-free, but it will still tax you basis whether you stayed invested for less than 2 years or more than 2 years, because there will be two NAVs, one for short-term redemption and one for long-term redemption.
And this is effectively the exact opposite, Kirtan, of what happens in Indian domestic mutual funds, right? That invest in the equity market or otherwise, where if you're investing, for example, in a balanced advantage fund or or a dynamic asset allocation fund and it has equity and fixed income, it's selling equity, buying fixed income, there is no tax incidence at that point. But there is a tax incidence when you redeem, right? So it's the opposite of what you're seeing in these gift funds. The question that I want to ask you is this worth it? Should you consider doing this? You said 10 to 15% allocation at this point to international, and you've also said that there's very little room at this point. So if you don't have that allocation right now, is it better off for you to wait a little bit? You might get a better opportunity down the road.
See, I think the first thing is that the GIFT City fund in itself is a great value addition because, like I explained to you in the first question, that ETFs are trading at a premium. Domestic markets are not allowed to invest in the global markets. Domestic funds are not allowed to invest in the global market. So, if at all international is a route that you want to take, GIFT City is a great option. But having said that, I currently feel that if you don't have international exposure at this point in time, I think you should wait out a little before taking any further exposure to the international markets versus domestic markets which look much better to us. And I'll tell you why. Like I said, the MSCI emerging market has delivered 3 times more return over the last 12, 18 months. NASDAQ, like I pointed out, has delivered 2 times. In fact, specifically talking about NASDAQ, 70% of the returns in the US market, even on a S&P 500 kind of an index, 70% of the returns are delivered by the top 7 stocks. Too much of concentration, betting on tech and AI. And if something goes wrong with AI that we probably might not be aware of at this point in time, there is absolutely zero room for safety at such run-up stocks and at such run-up valuations that we've historically not seen in general.
Yeah.
So 10% of your exposure you can definitely continue to, but like I said, there is very little room for error at these levels for you to invest more.
Okay, so we've covered international investing, and I think the advice that you've given is great at this point, right? Which is be a little cautious and stay with your asset allocation. Incidentally, we've got a great question that came through on one of our earlier shows, Kirtan, and I promised the viewer, this is Venkat from Bengaluru, seemingly a senior citizen, wants to invest for their grandson, for his grandson, 15,000 rupees per month. And he's asking what his mutual fund strategy should be. Is a passive approach, a simple approach, a good thing to have here?
I think why not have? Absolutely. I'm assuming that because he's investing for his grandchild, the time frame of investing is slightly longer, and his age is not the deterrent to the risk profile. And hence, looking at that, I think structurally the first thing that the investor has to understand is if he has 7 to 10 years of investment horizon, spread these investments across large, mid, and small, all 3, right? One approach is keeping it very simple. You take passives. Let's say you take a Nifty 50, you take a mid cap 150, and you take a small cap 250, and just invest across the indices. The second approach actually can be active, where you can still stick to Nifty 50 in the large cap space, but you can look at maybe a multi-cap fund to replace a mid-cap and a small cap active fund instead of a small cap passive strategy. Now, both of these strategies have merits and demerits, but I think if you want to keep it very simple, you can stick to passive, which should not be a problem at all with a 7-10 year view of horizon. But if you're looking at slightly better alpha, then I think Nifty 50 passive and mid-cap and small cap active can generate a little bit of alpha over 7-10 years.
Any names that you like? This is not a recommendation, but so he can narrow the list and take advice and get that?
I think one is PPF's FlexiCap, probably in the FlexiCap space. I like the Edelweiss mid-cap and the Kotak mid-cap in the mid-cap space, and a Tata small cap and a Nippon small cap in the small cap space.
Great. Thanks so much, Kirtan, for taking the time. Pleasure speaking with you as always.
Thank you so much for having me.
All right, so that's all about international investing, and I promised Venkat that I would get your question answered. Hopefully, this makes you and your grandson very happy.